The financial system fosters economic expansion and development by directing, organizing, and distributing savings to profitable industries. A few government-owned and private banks that focused on finance, manufacturing, agriculture, and trade made up the majority of the banking sector in the early 1990s. Prior to the 1990s economic reforms, the Bank of Uganda set the structure and level of interest rates. Unfortunately, the economy was hit by a deep recession, which resulted in a negative interest rate.
Both the deposit and the lending rates were far below the inflation rates. And for example, the annual inflation rate averaged 100% in the 1990s, while the nominal lending rates for commerce and term deposits accounts averaged 31 and 24% respectively.
Starting in the early 1990s, the government of Uganda implemented a number of changes to strengthen the financial sector. These reforms included strengthening monetary policy, enhancing resource mobilization, and fostering competition in financial markets, among others.
So these interventions covered three main areas. One, there was the institutional reforms to the Bank of Uganda and the public sector banks. And then two, there were legislative changes to the banking laws and the Bank of Uganda Act. And finally, the economic liberalization covering both interest rates and the exchange rate. So these were fundamental in terms of the reforms that were being undertaken. So without really deeply delving into individual reforms, suffice it to say that they unshackled the financial sector from a constraining common controls, thereby freeing it to intermediate savings and investments more effectively.
The Bank of Uganda was not able to administer monetary and supervisory policies based on expert judgment due to legal reforms, including the Bank of Uganda Statutes of 1993.
Monetary policy targeted average annual inflation of 5% through open market operations. And bank supervisions moved away from box-ticking exercise of compliance checks to a more risk-based supervision with minimal forbearance. The Financial Institutions Act of 2004 further strengthened the licensing, supervision, and closure of regulated financial institutions, which was fully delegated now to Bank of Uganda. And the Bank of Uganda executes this role following international best practices such as the Basel Core Principles of banking supervision.
Uganda's inflation has been relatively low in recent decades compared to the late 1880s and early 1990s, when core inflation was in the single digits, averaging 5% except in 2011 and 2012. Up to the recent rise brought on by the COVID-19 pandemic and the start of the Russia-Ukraine war, the Bank of Uganda kept inflation in the low single digits. Furthermore, lending rates have steadily declined from an average of 38% in 1992 to an average of 18% in 2021, whereas those in the East African community are at 16%.
For context, the annual headline inflation and core inflation rose to 10.6 and 8.8 in November 2022, up from 2.7 and 2.3 in January of 2022. So here, Bank of Uganda took serious actions to contain that inflation. And then secondly, on the lending rates, the persistently high lending rates increase business costs and crowd out some sectors whose rates of return may be lower, yet they are critical for economic growth and employment. For example, the agricultural sector.
The Bank of Uganda continues to strengthen its supervisory regime through supervision and the introduction of new products like internet banking and Islamic banking products, among others. The users for internet banking have increased to 17.7% in the year ending June 2022, from 7,000 in June 2021 to 800,000 in June 2022.
New products have emerged, including bank assurance, mobile banking, internet banking, increased card payments, and Islamic banking products are imminent, among others. In the year ending June 2022, the number of active users of internet banking increased by 17.7% from 700,000 in June 2021 to 800,000 in June 2022. Interbank transactions more than doubled, reflecting a 225% growth from 1.2 million transactions to 3.9 million transactions over the same period, while transaction volumes nearly doubled from 13.4 trillion to 24.5 trillion shillings.
In an effort to lower the cost of digital transactions, the Bank of Uganda and the Uganda Revenue Authority have called for more public and private sector regulations. They argue that the expenses associated with mobile banking, mobile money, and other digital or electronic transactions are now too expensive and are impeding to development of financial inclusion in the nation. According to Mike Ating-Ego, the Deputy Governor, Bank of Uganda, the poor are more negatively impacted by mobile money transaction charges because small transaction movers control the platforms.
There are several barriers that remain. Key among them are the high transaction costs. On net, mobile money transactions cost between 30 shillings to 1,250 for sending and 330 to 20,000 for withdrawing, and Uganda shillings 160 to 6,300 for payment of utilities inclusive of taxes. Interoperability costs range from 330 to 20,000 shillings. Furthermore, the charges are regressive, with the vulnerable poor who constitute the majority of users by transaction account bearing the heaviest burden. Statistics indicate that approximately 90% of the mobile money transactions are in the low value of under 50,000. So you can imagine that the tax burden is hitting the poor. So I hope, Chris, this message is sinking in here.
According to him, while there has been good progress in financial inclusion courtesy of mobile financial services, the cost regime is unfair to the poor, who also contribute most of the tax revenues from the sector.
Financial inclusion as a result of the above is now standing at 66% compared to 59% in 2017, with mobile money as a key driver. The report showed that mobile money services increased the value remittances by 36% and was associated with 13% increase in per capita consumption. However, the same report indicated that 41% of the Ugandans could not access financial services due to the distances involved in reaching access points.
The cost of moving money from one platform to another, which varies from provider to provider, is one of the factors contributing to the high costs of mobile transactions. The National Payment Systems Act has increased the number of service providers over the past 1.5 years, although this has not yet resulted in a significant decrease in costs. The national payment switch, according to the Deputy Governor, will lower transaction costs between networks once it's operational.
We've had a number of consultations with the key stakeholders of this national payment switch. The payment system providers, the banker, the development partners. We've had significant discussions with them to understand better that what kind of switch, payment switch, does Uganda require, given our systems here. What type of switch do we require? So we have had the discussions, and as a result, the discussions have culminated into what we call the business and the technical requirements for this business switch.
The countrywide switch will assist in monitoring transactions as they happen and allow Uganda Revenue Authority to immediately tax them, according to Moses Kagwa, the Director of Economic Affairs at the Ministry of Finance. This, along with the anticipated decrease in the cost of transferring money, will, in his perspective, result in an increase in revenue collections.
At least you get these transactions on the system, and you can see the transactions that are flowing. If they are business transactions, at least you will get to know that one business has received money from another business, or somebody has sent money to a business through this system. Now, what has been happening is that the companies, the fintech companies, the companies under Airtel and MTN, have their own systems, which have been expensive. So the cost of remitting this money has been high. But if we have a national payment system, that would mean that the charges are going to be low.
Even with the increased digitization and how it is assisting in revenue collecting, John Musinguzi, the URA Commissioner General, stated that a sizable portion of the economy, the informal sector, continues to be the most difficult to tax, mostly due to lack of records. According to him, this means that although they are significant economic contributors, they cannot be tracked.
It will help us have better visibility of financial flows and therefore of incomes where money is being made. And that will give us an advantage or clear information on how to tax them.
It is important to digitize money and the flow of incomes. That way, it leaves a trail, and that trail helps the tax administrators to effectively assess and tax those transactions without any guesswork. Naomi Mtumba, Smart 24 TV.